As most investors are talking about AI, data centers, the Iran war, oil, silver, gold, all of this caused some volatility in the markets, and it was a golden gift for banks. The financial sector sometimes is called a boring sector. It's a sector that it's not too hard to analyze. It requires margins, loans, provisions, and just making sure your balance sheet is well protected and you follow the regulatory ratios. But in this quarter, we'll see how volatility was the biggest blessing for those banks. Here is the graph that is breathtaking. $45 billion in revenue for the first quarter from trading activities in fixed income, currencies, commodities, and equities at large banks. By large banks, we selected the top 6. Goldman Sachs doing tremendously well. JP Morgan Chase almost at $12 billion in revenue, up from 7 from last quarter. So you start thinking, how is it possible the banks went from 32 billion accumulated to 45? It's almost a 50% increase. It's a 45% increase. Despite the volatility, despite everything that's happening. Well, when volatility goes crazy and banks just print, no one is surprised at this point. Because volatility is a tax for most investors, but a windfall for bank trading desks. So we need to understand as well what trades more in the market. So gold is number 1. You can see the volume is daily 361 billion. And then you have treasury bills 186, and then your euro to GBP 169. That makes sense. England is constantly sending payments to continental Europe, and then you have the 7 to 10 year treasury and the Dow Jones stock at 100 billion. All of those cross 100 billion. That's where the real prices are. And it seems like commodities, you can see the gold average daily volume has a 4-year growth of 169%, which also benefit a lot of these companies, because the more volatility, the more uncertainty there is, people trade more. There is more need to exchange positions. And gold was one of those, but let's analyze. So why is volatility a gift? Because $45 billion, as we said, in a single quarter is extraordinary. Record trading revenue in a volatile quarter isn't coincidence. It's the business model of trading platforms and banks. As the spreads widen, hedging demand raises, client flow picks up because they need to adjust to the portfolio. There is redemptions. There is panicking around. So that requires more and more trading volume and trading action across asset managers, insurance, and investors. So the stress that hurts most balance sheets helps trading desk because you're feeding into it. It's like when you, for example, there is a winter storm. Well, what happens? More people use electricity because they need to stay warmer. They're a little afraid that something is going to happen. So then the grid can get a bit saturated. So geopolitical chaos plus market volatility, record bank profits always follow volatility. As we say, war volatility was a gift. And we analyze this to show you how trading platforms and the trading desk of banks actually work as an utility. It's kind of a defensive sector. They actually increase, just the same as risk platforms, your Riskband, your Aladdin, BlackRock. All of these platforms, when there is more risk, investors require better software. So it's actually kind of the opposite, that the more pain there is in the markets, these companies benefit the most. So you can see rolling year correlations between trading platforms and also investment platforms like Interactive Brokers, Robinhood, Nasdaq, BGC Group, Virtu Financial, Intercontinental Exchange, TradeWeb, Market Access, CME Groups, and CVOE Global. You can see TradeWeb, Market Access, CME Group, and CVOE. The last two, big into the derivatives trades, clearing, TradeWeb and Market Access, probably hold 80 to 90% of fixed income trading. And you can see the correlation with S&P 500 is negative, except for TradeWeb, but it's extremely, this is in bips, extremely low as well. And with VIX, it's actually positive. When VIX goes up, these platforms actually benefit from that. Not as much as Interactive Brokers and Robinhood and Nasdaq, because they require more of the retail investor, which they don't really charge, but the other platforms they do. Same. Now let's do Q2 2025. So because Q1 we had relatively okay, Trump became to power. Q2 was Liberation Day, don't forget, April 1st. Just started there. Again, market access, CME, CBOE in the negative, correlation with S&P, and very, very small correlation with the VIX, almost positive in that sense, or positive in that sense. And then in the second half of 2025, the S&P average daily return was 12 bips. The daily return of the VIX actually moved negative 20 bips. But then again, same story. TradeWeb, market access, CME, CBOE, positive correlation with VIX, except for TradeWeb, but and then negative correlation with the S&P. But TradeWeb is extremely low. Also, TradeWeb has a lot of business in equities, but market access has more into fixed income, so that could explain why it's still not as much. And then lastly, which I think is very important, is year to date, which is we saw all the bank profits coming from their trading desk, and we are using similar platform because banks don't really show how much revenue, well, it's kind of hard to analyze a bank because the stock, banks have extremely amount of different products and revenue sources. But for the trading, we would like to see more into the trading platform. So again, year to date, market access, CME Group, CBOE, negative correlation with the S&P, daily returns positive with VIX, and TradeWeb very close. And as you can see, ICE is also close to that derivative part. As you go lower more into the institutional trading, your correlation with volatility increases, while your correlation with the S&P decreases. So extremely interesting to see how trading platforms and trading revenue at large banks actually benefit from the volatility. So next time when there is blood in the streets, don't forget where you should put not your money, but also your interest. Let us know what you think, and please leave a comment and subscribe. Thank you.